Moritz Kraemer, the head of sovereign ratings at Standard & Poor's. Moritz, is the worst over for the sovereign debt crisis?
Well, I should say to that the majority of the European sovereign ratings still carry a negative outlook, which indicates that there is a reasonable chance that the ratings may be lowered again this year or next. So the short answer is it's really too early to declare victory.
Victory, but maybe the worst is past us. Maybe that's it.
Well, as far as creditworthiness is concerned, which is what I could speak to, we think that the risks still are to the downside and things could get more complicated for a number of sovereigns.
Now, is that because of what we've just seen in Greece? We've just had this biggest sovereign debt restructuring in history, but we've seen collective action clauses coming into play. We've also seen the European Central Bank not participating with its bonds. How is that affecting the pricing of risk in other sovereigns?
Well, I think the sovereign bond market in Europe has changed quite a bit over the last few years. We have most importantly, and you mentioned it probably, there's been a new sort of creditor class coming in, which is increasingly a preferred creditor, as they say, meaning that it's a creditor that would not participate in restructurings in the future. It was always the case for the likes of the IMF, the World Bank, EIB, etc. But of course the ESM, the European Stability Mechanism, which will be introduced later this year, and the ECB de facto are also in this group. This, of course, means that if you are a bondholder, you have sort of more and more people sort of jumping the queue ahead of you. So basically, if there is a restructuring in terms of defaulting or restructuring debt, the recovery that you could expect is going to suffer.
So is that increasing the cost of the cost of debt for sovereigns?
Well, you should think so. If you put yourself into the shoes of an investor, knowing that he has higher risks to bear in terms of sort of lower recovery if things go wrong, you want to be compensated for that risk, right? And the way you're compensated for risk usually is to demand a higher coupon. So this could be having lastingly increasing interest costs for vulnerable sovereigns and banks on the periphery.
Does this help explain then what we're seeing in the Portuguese bond market, where you've got the 10-year yielding at 13.5%? Is that a result of the fact that you've got subordination of the bondholders?
I think that would be an oversimplification. There are many issues. Portugal is struggling with a number of challenges: fiscal, economic. Not so much politically yet, but that may come down the line in terms of keeping the consensus in society. This is an additional, what we're talking about, preferred creditors, is an additional complication for the Portuguese government in its quest to return to the capital markets. But it's not the main reason for the challenges, because the problems have started well ahead of these type of initiatives.
A lot of people are looking at Portugal actually and thinking that restructuring is inevitable there. Do you think that that's correct?
No, I don't think that's correct. I mean, Portugal, in our view, is sort of the weakest credit in the Eurozone other than Greece. Which has to do with some of the structural challenges they're facing. But compared to Greece, the debt is not as high. The implementation capacity for policy reform, the institutions in Portugal are much stronger than in Greece. So I think they have a good fighting chance. Nonetheless, we rate them in non-investment grade, which indicates that there is a non-negligible possibility of things not working out and the need for restructuring happening. But that's not the base case for us right now.
But still, a little bit of optimism for Portugal. Thank you very much, Moritz Kraemer from Standard & Poor's.